But I think investors were positioned for the Grinch to steal Christmas. And they're waking up and realizing that trends have already been in place, that the election has not changed a pro-cyclical stance that's already been in place.
So it's up in spite of Trump? That's what you're saying? We were already doing well, so even Trump can't hurt the markets? It's nothing in his policies that are causing this to go?
I think from now going into year-end, the trends are already in place. We've already been talking about an earnings trough.
If he was going to be the disaster that, I don't know whether you were forecasting, but if it was going to be the disaster that Moody's Analytics, you know, and I love the way people say it's Moody's. They don't say, no, it's Moody's Analytics run by Zandy. They say it's Moody's. The disaster in blowing out the deficit, isn't that eventually going to come home to? So next year is going to be horrible, right?
Well, we've really had a pro-cyclical stance. We've been saying earnings have
avoiding
troughed.
what I'm trying to get at? Are the policies going to be more positive for the stock market than people said, the Trump policies?
I would say that investors are pricing that into the market. The market is saying that it's not as bad. I mean, the Dow almost closed at a record all-time high.
What's not as bad? What's not as bad?
In terms,
it's not as bad. Which of Trump's policies are so bad?
That the election process was not as bad as portfolios have been positioned. Portfolios have been positioned in a very defensive way. And seasonality-wise, going into November, December, and January is the strongest period for the stock market.
Were you listening to Phil?
I listened to Phil.
What were you saying, Phil?
I know Phil. He's a dear friend.
All right, 15% corporate tax rate, repatriation of earnings, less regulation, repeal and replacement of Obamacare. Aren't any of those things actually? Aren't any of those things positive? Dodd-Frank?
It's all good. The one thing that I think the market hasn't figured out or hadn't figured out up until yesterday was the difference between dynamic analysis and static analysis. The conventional thinking was if we cut corporate taxes down to 15 or 20%, if we cut personal taxes, and that's lost revenue. And that's the static analysis. What they didn't understand is the stimulative effect of the economy from reducing those tax rates and creating stronger economic growth.
Cabrera started on if they get less money. What if they actually have to shrink the size of what they're used to spending because they have less money? Is that a bad thing?
That's the whole point.
Don't get her started.
What's the bond market telling us? Is the bond market telling us that growth is coming or that inflation is coming?
Absolutely. Well, both, because and the Fed is going to be hiking interest rates. So you've got a situation where GDP growth the last 7 years has been limping along at 2%.
So offset that. So if you think interest rates are going up, but the economy's getting better, what does that mean for the stock market? Usually you don't fight rising interest rates. It's usually bad for the stock market.
But we're going higher because you've still got relatively benign inflation and interest rates by historical standards. If economic growth is getting back to trendline 3% or, God forbid, 4%, which we think is possible, you're looking at stronger corporate earnings growth and higher stock prices.
You're not